Yeah, thanks a lot, Trey. Appreciate it. Glad to be here. And definitely an interesting topic because I think we can all agree that ETFs in general are becoming an increasingly larger and larger portion of the securities markets these days. So definitely a timely topic for sure. If you want to, I think the best place to start is starting with some basics, really. And, let's start with ETFs themselves. ETFs are a pool investment security. We can think of these as a basket of securities and they can be traded like a stock. In fact, ETFs were actually born out of Black Monday in 1987. As the SEC kind of dug into what had gone wrong, they realized there really wasn't a security to represent the broad market. Not unlike the futures market, which had, of course, the S&P 500 index futures, and they actually believed that if they had something like that, it might have minimized the damage that day. So they expressed an interest in developing a new type of security, basically, and that started in 1993 with SPY, or SPY as we affectionately call it, the largest and most actively traded ETF in the world. So the thing about ETFs is that they solve the problem. Now, investors fully embrace mutual funds, and as the birthplace of mutual funds, we here at Fidelity know a thing or two about them. The mutual fund provided a simple way to diversify portfolios. And this was especially true for longer term holdings, such as retirement accounts. However, what if that wasn't your time horizon? What if you were more of a trader? How could you achieve the same effect? And therein lies the inherent problem with mutual funds, especially for short-term focused traders. They were only priced once a day after the market close, which means you won't know the price during market hours, impossible to tell how much you could buy or really how much you'll receive on a sale. And they couldn't be traded in and out of over short time frames. What traders wanted was something that provided the same diversification characteristics of a mutual fund, combined with the ease of trading similar to stocks. That solution, of course, was the exchange traded fund, or ETF. So the question becomes, well, why would you use an ETF? Well, now that we understand the origins of ETFs and the void that they filled in the market, what are some other reasons to use these types of securities? The first reason that comes to my mind when I start to think of these is to gain exposure to a particular sector or strategy. We talked about how ETFs can give you diversification. It can also be a strategy to reduce your overall portfolio risk. You could, and by that we mean spreading around your investments so that your exposure to any one type of asset is limited. The same can be true with regards to sectors. We can use the business cycle and historic returns during different phases to position our portfolio correctly. Let's say we look at our portfolio, we decide we need to make a change, and we decide that based on certain macroeconomic factors, we want to gain more exposure to a certain sector. Say, for example, you want more information technology stocks on in your portfolio. Well, here's the thing. You could research individual names to buy, but that could be really time consuming. And quite frankly, if you don't have an expertise in these areas, it could be difficult to narrow down your focus. You can quickly gain exposure with an ETF. In addition, you can focus on other aspects as well, such as market volatility, commodities, even countries with ETFs. And that's the variety, and that's really essentially why we're here today. Now, another reason to own ETFs is simply because they're relatively cheap. Operating expenses are incurred by all managed funds, regardless of structure. But most comparable ETFs continue to be less expensive than mutual funds. For example, consider client service related expenses. Those are passed on to the brokerage firm. Brokerage firms issue statements, they issue tax reports, 1099s, and ETFs are included in all of those. Therefore, ETF costs can be streamlined compared to mutual funds. The reduced administrative needs result in obviously lower overhead. Another example is that ETFs don't charge the annual 12b1 marketing fee. So the result is that a portion of that savings is passed on to investors in the form of lower fund expenses. So again, ETFs also avoid any short-term redemption fees, and some mutual funds charge up to 1% if held for less than a year. So again, addressing that short-term trader with ETFs. Another draw, of course, for ETFs is that they're much easier to trade for investors. They offer the trading flexibility that was missing from mutual funds. So like stocks, ETFs have continuous pricing, meaning we can trade them throughout the trading day. And if I hop over to Active Trader Pro, we can see that here with a quote. I'm going to pull up a quote here for SPY. This, of course, is a active, very active, I should say, ETF that does the best they can to mimic the S&P 500 index. Again, I just pulled this up strictly for demonstration purposes. If you're looking for an S&P 500 index ETF, there are plenty of options. I just chose SPY because it is the most active. And we can see that from the current quote. Notice the volume so far, 20 million so far, and the bid-ask spread is only a penny wide. We'll talk about that more in a bit, but for now, we can see this particular ETF is actively traded throughout the day like an individual stock. And with that comes the ability to place advanced order types, such as trailing stop orders and conditional orders. In addition, we can certainly do things with ETFs that you can't do with mutual funds. They can be purchased on margin. You could sell them short if you wanted to. You can trade options on them. Of course, I'm not recommending you use margin to short ETFs or trade options on ETFs, but these are the types of things that you can do with ETFs, much like stocks. Transparency is also another benefit of ETFs. Generally, ETFs are required to publish their holdings and weightings daily. Let's take a look at an example right here. So I'm going to pull up FELC. This is a Fidelity Enhanced Large Cap Core ETF. And if I go to the right here on this menu and click Research, we'll get up a research window for FELC. Now, you can see right here on this link, once we open up this page, we're going to go to some more research. And what I like to do here is take a look at this link right here, Prospectus Holdings and Reports. So if I click on this, that's going to give us a pop-up with some more choices. Here we can access the prospectus, the financial statements, and all the way to the right, let me pull this bumper here, all the way to the right, you'll see Daily Holdings Report. Now, if I click on that, that's actually going to give us the holdings for this particular ETF, and it's updated daily. So as you can see, this is the one from at the end of the day yesterday, and it gives you every holding that they have in that particular ETF. It doesn't get much more transparent than that. Mutual funds publish their holdings, but just not as frequently. A mutual fund typically publishes its holdings every 1 to 3 months, depending on the fund's investment policy. Also, they're tax efficient compared to mutual funds. Obviously, taxes are an important consideration for any investment. And when comparing the two, ETFs actually have a lower capital gains, which are payable only upon the sale of an ETF. Now, mind you, I am not an accountant, so we'll leave a deeper dive into taxes for the tax professionals, but that should provide you with a good base for a conversation, at least to understanding taxes. So, that being said, now that we have a good understanding of ETFs, what are some things to watch out for? Well, I think one consideration would be the expense ratio. And this is how much of your investment will be deducted annually as fees. Here we typically look for expense ratios less than 1%, meaning that for every $1,000 invested, you pay about $10 a year in expenses. A good ratio is typically under 0.2%. Another factor when we're looking at ETF selection is tracking error. And that's a measure of how well the ETF tracks the performance of a benchmark, which can certainly affect total returns. If you're looking to match the performance of an index, such as with the S&P 500, you'll want to find an ETF with low tracking error. On the flip side, the price of an ETF that holds less liquid securities, such as, say, fixed income securities or stocks that are traded on a small foreign exchange that is closed during U.S. trading hours, those could vary more significantly from the NAV of the securities in the ETF. Of course, we wouldn't want to look at factors alone to make a decision, but these are certainly some elements to consider. So now that we've got some background information on ETFs, Peter, why don't you take us through some of the research that we have available here at Fidelity on ETFs?
No, absolutely. I'm happy to go ahead and do that. And I like how you frame the conversation, especially given the fact that over the years working here at Fidelity, so many clients have asked questions about ETFs in general, or even about buying or selling different products. And my response to that has really always been, if you are going to be making a change in your portfolio, ask yourself, what is it you're trying to accomplish? And also, how is that going to change the current structure of your portfolio as it stands right now? Now, many clients had somewhat of a grasp, but weren't able to go ahead and maybe speak as detailed as they would like, which is why what I'd like to do is carry on that conversation that you were already having, but then also go ahead and show a resource Fidelity has so that many of you out there in the audience would have the ability to see how your portfolio stands right now. Because it all goes back to that why. You know, the why invest in ETFs is going to be unique for everyone out there, but I'd agree with you. From my experience, I'd say more times than not, you're looking to fill some type of gap in your portfolio composition. Maybe you are looking to increase diversification. Potentially, you could also be looking to gain exposure. You already mentioned a few. For me, fairly knowledgeable, but of course, I also know my limitations. So when it comes to investments in, let's say, the bond market or perhaps international markets, I know enough to be dangerous, but maybe not enough to be comfortable. So framing the conversation as to utilizing ETFs as a way to maybe fill some gaps in your portfolio. And also going back to those questions I would ask clients, what I wanted to point out was from Fidelity's kind of portfolio homepage, which many of you I'm sure are very familiar with, depending on your screen size, you may need to click on more here as I'm demonstrating now, or you might already see this analysis selection. By clicking on analysis, what that's going to do for us is actually give us a pretty good view of our portfolio as it currently stands. Now, you can, of course, incorporate, depending on the number of accounts that you have, either an individual account, you could do a grouping of accounts, completely up to you. For our test environment, got to say it's pretty cut and dry, straightforward. We've just got this one account here. But aside from the number of accounts that you have access to looking into, really what I wanted to show was this asset allocation. When we're thinking about potentially structuring our portfolio or what we're going to invest or how we're going to invest, it's nice to know where we stand currently. And what this will do is show us from the standpoint of domestic stock or foreign stock or bonds, short-term investments like cash or other types of marketable securities, as well as a couple of other different types of groupings, classifications for investment types. What is our current weighting? In this portfolio, once again, by no means something that you should be trying to replicate. Maybe you notice that there is a domestic stock of 85%, foreign stock, a little exposure, but pales in comparison to domestically what you own, so on and so forth. Bonds right now, 0%. I think above and beyond the, purpose of seeing where you stand, you want to know if this is by design, based on what your goals are, based on what your outlook is, or is some of this weighting potentially an accident? Maybe you have really neglected your portfolio for some period of time, given life events or different challenges that you might have on the day-to-day, which is perfectly understandable. The other real benefit of this page is the stock analysis, which I want to focus on for just another minute or two before we get into that ETF research. Reason being, under stock analysis, this is going to allow us to, once again, get that bird's eye view of our style. How are we currently invested as it stands right now in what's called a style box? Now, those of you that might be unfamiliar with that technical, jargon or terminology, a style box is nothing more than kind of a little game here of the market capitalization on the left, be it a small cap company, mid cap company, large cap company, and so on. And then the valuation. Is this a value company that's maybe been around for quite some time, is growing, but not maybe at the pace of what would be classified as a growth type of company? And once again, no right or wrong answers here, seeing how your investments are currently categorized. And I think given that context of classification, that can help identify if there are some gaps, maybe from a stylistic standpoint, be it either valuation or market cap that you're looking to incorporate. Down below, it's also going to go ahead and give us this chart, which is going to show us either in dollar amounts or percents of our portfolio invested in those different types of styles. Now, if it's a individual stock position, of course, it's going to go ahead and show specifically what's invested and where it falls on the, in this case, large cap value for Bank of America and Citigroup. What I think is actually fantastic about this page is that if you do have a mutual fund, or for what we're here to talk about today, a ETF, that's actually going to break it down from those other types of basket holdings that that fund or ETF has, which is, I think, extremely powerful to see. If I'm invested in a fund, I probably am looking for exposure or that diversification component that we spoke about earlier. And this tool will go ahead and actually break down where that exposure lies, even within the confines of one specific fund with a number of holdings. Now, we do have the ability to go ahead and take a look at this from a sector exposure standpoint as well. And it's going to be laid out very, very similarly. Down below, what you're going to observe are the different sectors that this current portfolio is holding, as well as this horizontal line is what the weighting of, in this case, the Dow Jones US Total Market Index weighting for these different sectors is. Now, once again, no right or wrong answers, but going back to those conversations that I would have with clients over the years, when I ask them, Okay, did you recognize that you were so overweight in financials or communication services and underweight in information technology? Sometimes the answer would be yes, absolutely. I feel very confident about these couple sectors and less confident in this other sector. Or the answer sometimes would be no, I actually had no idea. Maybe I invested in a number of securities that I thought were fitting the mold for quote unquote a well balanced portfolio. Come to find out when you're taking a look at a tool like this, maybe there's more than meets the eye. So the big question I'd always ask those clients is your portfolio composition by design or as maybe something need to be monitored or adjusted? And of course, if that is the case, then going back to should I buy or sell this stock, ETF, whatever it might be, how is that going to change your composition moving forward? And is that what matches up with your outlook? Now, that takes us to the research part of things, like Albert was mentioning, news and research ETFs. Let's say that you do want to search for some types of ETFs. News research ETFs, like I had just clicked on, is going to go ahead and bring us to this landing page that Albert was on before. This is where we are going to have access to the ETF screener, where you're able to go ahead and look for different characteristics depending on what it is that you're trying to accomplish. I think Albert's going to talk about that here in just a few minutes, so I'll save that for him. But you can also go ahead and get a barometer for what maybe ETFs are doing on a day-to-day. For instance, here we have the drop-down boxes to take a look at under this ETF market movers section, U.S. equities and the top gainers over the past 5 days. You can look at this from a sector basis, international, bond portfolios, commodities, you name it. Hidden in plain sight, I feel like, are these drop-down menus, which is why I wanted to go ahead and draw everyone's attention towards it. Let's say, for instance, you wanted to see out of the U.S. equity ETFs, which has the highest 90-day average volume. Well, with just a couple clicks, you're then able to go ahead and break this down, take a look at those top 90-day volume average kind of components, and notice SPY or QQQ, IWM, and maybe some of these other names that you have already heard of, one of which Albert already used as an example. The other couple things I wanted to show on this page were going to be down below. Bear in mind, above and beyond the scope of what Albert and I have to talk about here in this hour, there's going to be still a tremendous amount of education that Fidelity has to offer. Understanding ETFs in this tile down here has some great short videos and articles that you'd be able to go ahead and glance at. So potentially bookmark that for later if that's something that you'd like to come back to. Up above, last thing on this page that I would really speak to is the search by stock. ETFs, as I had mentioned, have been kind of growing in popularity over the years. And as you can imagine, I've fielded a number of interactions with clients that said, you know, I'm trying to get exposure to this company. I heard they do this, that, the other. And I don't want to just invest in that one company. Is there maybe an ETF that provides a little bit more diversification, but still fits the mold for maybe that theme or that factor, you know, what that company is trying to solve for and profit from? Now, here are just going to be, depending on different market movers, some different kind of examples of being able to do that. And for instance, if you wanted to click on any of these, you can. You can click on BAC here for Bank of America. Maybe the theme you're after is even more financial exposure. Going back to our model portfolio, already having quite a bit of financials, maybe you still feel like you want more. You could certainly go ahead and do that by either selecting any that are down below. You could also type in any other symbols that you want. Maybe you're looking for an ETF that holds Bank of America as well as JP Morgan. Well, by choosing this, you're then able to go ahead and view matching ETFs. And the power here is that it's going to go ahead and actually break down the symbols, the fund names, as well as what those funds have exposure to the names that you had given it, as well as a total exposure. Now, you can fit up to 5 different symbols. They certainly do not all need to be within the same sector or industry. It's completely your prerogative. But let's say that you were looking for maybe adding a couple credit card companies. Maybe you wanted to add to the mix Visa and MasterCard. Updating this table, view matching ETFs, is then going to go ahead and dynamically change. It's going to update. It's going to give us maybe some different choices or selections where you'd be able to see what that breakdown of these ETFs is, as well as what that total exposure is going to be. Now, total exposure is extremely important. We're going to get to that momentarily when we talk about the composition, because with ETFs, sometimes they're going to have a name, you know, U.S. Financial Services. Many of you out there, if you just read the name, the iShares U.S. Financial Services ETF, you might think that hey, I'm going to buy this ETF, I'm going to invest, and I'm going to have access to all of these different types of US financial services companies. Would you have guessed off the face of it that four companies alone made up over 30% of the total weighting or exposure of this ETF? Maybe that fits the mold for you. Maybe that's a bit high. Maybe you still want financial services ETFs selection, and then they're probably typing in an ETF that they have in mind. I'll stick with SPY since Albert's already showed that for just a moment, and I'll add a little bit more context and also some of those different types of data points that he was already calling out. Under the ETF research page, what that will do is launch you to the overview. And this is going to contain a little bit of everything, is what I like to say, kind of a grab bag top level. Off towards the left-hand side, we've got a detailed quote. We've got a sample chart. Down below, we see some analyst ratings, as well as the top 10 holdings that are held. Now, back to that detailed quote, Albert already discussed a bit about expense ratio. If you were maybe researching an ETF and wanted to see quickly where that expense ratio was and maybe how much that it was, a detailed quote under the overview is going to be a quick way that you can do that. In addition to seeing how large is this fund, what is the tracking error? That's something else that Albert had talked about, 0.02%. What that means is if the job of SPY is to try to track or mimic what the S&P 500 is doing from a percentage gains or losses standpoint and following those flows, then 0.02% off the beaten path, pretty good. They're pretty good at doing their job. It seems, though, if they are trying to follow that benchmark from a passive standpoint, and we'll talk about that more as well. Others that are of interest to some clients I've dealt with have been what this median bid-ask spread has been. A fancy terminology aside, folks, this just means how efficiently can we get into and out of this product. Some of you in the audience might be looking at ETF exposure for the long haul. You're thinking about, I've had mutual funds in the past, but it's something I maybe want to trade more frequently. And whether I do or not get into or out of it every day, every week, every month, I at least want that flexibility to do so intraday, like Albert had discussed. What this bid-ask spread is going to do for you is show you essentially how efficiently can you get into and out of that product, which for the buy and hold investor might be a little more minimal in your thought process. But for someone who's trying to use these vehicles to trade very, very frequently, how efficiently you can get in and out might be something that is going to make up your mind as to whether you want to invest in ETF that you're seeing here versus maybe another one that has a more efficient bid-ask spread. 0.01%, that's, splitting hairs about as close or as low of one that you're going to view. Now, I won't talk about each and every single one of these tiles, but on this ratings, you're able to go ahead and see FactSet ratings, Morningstar ratings, whether they're grades or stars. Folks, you can view these specific reports, which I'd encourage you to do so, but also don't just take an A+ or A rating or 4-star rating, 5-star rating, whatever it might be on face value. You can view details and specifically see out of their rating information, what's the method to the madness? How are they coming up with this calculation? What goes into it? Efficiency, tradability, some of what we talked about so far, some of which we had not. Now I want to go ahead above and beyond just the kind of top level holdings and actually go ahead and finish my little portion here on the research with these composition. Now you can view the holdings here. Albert had already shown us how to do that, but up above, bear in mind, I had only looked at overview so far. Folks, there is a tremendous amount of information that's held here within this research page. I'm going to click on composition for just a moment, but make no mistake, when you want to look more granularly at distributions and expenses, different ratings and analysis like we had shown briefly, other types of performance and risk measures or comparisons, really everything that you can imagine is going to be here. So bear in mind, some of these tabs are hidden in plain sight, but each of them will cater towards and provide you information that you might find helpful in making a decision. Top level, I think portfolio prospectus is going to be helpful. Now, like Albert already mentioned, the SPY ETF, kind of the original here, tracking the S&P 500 by design, goes without saying. Well, you would think it's going to be a U.S. equity type of fund, a large blend, and it's passively managed. I'll talk more about the difference between passively managed and the kind of growing popularity of actively managed funds here shortly. But that goes back to that passively managed, looking to very simply track some type of benchmark or index, in this case, the S&P 500, and going back to that tracking error being low and potentially that expense ratio being fairly low as well. Now, above and beyond just those top 10 holdings, you can imagine here and see, well, where are these located from a region standpoint, or maybe from a specific country? Market capitalization as well. Here's a little bit of that style map. This is what I discussed previously under that analysis tab. You have the ability to see if you are going to be gaining exposure throughout the style map, which, going back to how your portfolio is comprised, might be helpful or fit the mold for specifically what you're trying to accomplish with your next investment or trade. The same scenario here for that sector exposure. Now, if this is once again passively following the S&P 500, it stands to reason it's going to essentially be laid out specifically just like the exposures of the S&P 500 index. But do bear in mind, even a passive fund that's tracking an index, I should say, still will have some minor changes. You think about index rebalances that take place sometimes quarterly or semi-annually. That would be when a company is kind of added to the S&P 500, or maybe an older company that no longer serves the purpose is going to be removed. But when it comes to a passive fund, especially one that's following an index, you would expect that there are going to be more minor changes. And even when there are minor changes or trades, it goes back towards trying to closely replicate the index or benchmark that it's designed to follow. I think that this portfolio composition really comes up and is extremely important when we start looking at maybe some different types of sector exposure, when we start to take a look at maybe some international exposure, some bond exposure, you name it, being able to actually visualize and see specifically where you're able to go ahead and gain some of that diversification from. Albert, I know you're going to walk us through a little bit more about sectors specifically, so I won't draw too far on that. So far, what I have shown the folks is that if you already have an ETF in mind, being able to utilize the research page to learn more about it, but potentially there's some of you in the audience out there that maybe know a little bit about what it is that you are trying to invest in. You just don't have a specific symbol, which is, I think, where that ETF screener comes into play, and a little bit more of a discussion on the sectors in general.
Yeah, good stuff, Peter. That's a lot of great information there. And again, as Peter said, we have so many tools for research. We could probably just do an hour just on research. But if you don't know exactly what you're looking for, we actually have probably my favorite tool here at Fidelity that will help you to determine what it is that you're actually looking for. And that is the screener itself, the ETF screener. Now, I'll start by saying that, again, this is a very powerful research tool. I've spent a lot of hours in this myself, but what it does is it gives you the ability to focus our search based on criteria of our choosing. So I want to take just a quick tour of what that actually means. I'm going to launch this from the ETF screener here, and I'm going to go to Start an ETF Screen. Now, I make that distinction because there are other ways to launch the tool, which I will show you a bit later. But right now, we're going to stick to this and kind of get a little broad overview of what the screener looks like. So on the left-hand side here, we have all of the criteria. And if you add up the numbers, and I'll collapse this so we can kind of get them closer. If you add up all these numbers, you'll notice that we have about 87 different criteria to choose from. And if I click View All, we get a chance to see all of them laid out together. Now, this list can be a little bit overwhelming, but thankfully we do have help. If we click the criteria definitions up here in the right-hand corner, from here, we can learn a lot more about these criteria. So, for example, maybe I want to learn more about something like the Sharpe ratio. Well, here we have the Sharpe ratio. It's going to tell you exactly what it is and whether or not it's something that you want to consider within your own search. By the way, since we are here, I will show you this as well. This section right here about these sectors and industries, I think does a tremendous job of telling us a lot about the classification standards and giving both definitions of the sectors as well as the 69 industries associated with the sectors. And we can scroll through here and find more information about those individually as well. So again, that's from the standpoint of criteria definitions. But let's go back and let's go ahead and build a screener. Let's see how this thing actually works. Now, instead of starting from scratch, I'm going to take a look and we're going to do something from the pre-built screeners here in the center of the screen. Now, If you're new to the screener or even ETFs, this might be a good place to begin because these pre-built screeners take some popular searches and get them started for you. So for example, I'm going to take a look at sectors. Now, instead of searching through criteria and find the sector I'm looking for, I can go to that quick launch, pull this straight up, and now I can see the choices that I have here with regards to what sectors. I'm going to choose technology for now. Now, this is put together by Morningstar, identifies which ETFs are in the tech category. Now, you may be thinking to yourself, well, technology isn't actually a sector, and that's right, but technology can reach across many sectors. So our focus for now is going to be on information technology. And so my first criteria, in order to get ourselves narrowed down for that search, is going to be looking for that. So if I open up the basic ETFs, I'm going to actually go down to exposures. I'm going to go sector exposure. And right away, I can see that there's a lot of different choices here. As I said, many different sectors, but we want to focus on information technology. So already we've gone from 120 down to 117, but at the same time, I want to really make sure that I have a high exposure to this particular sector. So I'm going to actually make sure that my exposure here is at a minimum, let's say 75%. And now we're down to 46. So the next criteria could be the size of the ETF, right? We want to filter out some of the smaller offerings. So I'll go back down here to my criteria. I'm going to go to net assets. And once I pull up net assets, it's going to give us some choices here. But I want to say, you know what, as far as the size of this, I actually want something that's at least $1 billion in assets. Again, I want something very large. So now we go from 46 down to 18. And along those same lines, we may only want actively traded ETFs. So I can go back down again to my criteria. I can go to trading characteristics, and I can look at volume. Now I'm going to look at, I don't really care as much about the shorter term stuff. I want to know longer term. I'm going to look at the 90-day average. So now I can put that up here as well. And you can see our choices once again, very high, high. So I'm going to choose very high. But at the same time, I'm not entirely sure that I want to look at something that's only trading less than 200,000. So I can also go up here and do show chart. And this is going to give me a visual breakdown of what the different volumes are. I'm actually going to be able to move this back and forth. So I'm going to put it closer to, say, something in the neighborhood of close to 500,000. So just to recap what we've done so far, we've gone through, we started with the technology theme. We narrowed it down to information technology. We narrowed it down to the largest of those information technology ETFs. And then we went and said, you know what, I only want the most actively traded of those. So we went from 120 choices down to 7. A much easier way to start our next part of researching whether or not we actually want to own these things. That being said, maybe we want to dig a little deeper. So I can actually go down here to analyst ratings. Peter touched on earlier. I'm going to say Morningstar ratings. And for my purposes, I only really want the 5-star rated funds. So now, once again, we've gone from 120 different options down to a mere 4 options that meet these criteria for us. And again, the idea here is to take this from a larger point and bring it down into much more digestible bite-sized pieces. And certainly 4 versus 120 will be a lot easier. So these 4 funds, and probably some names that you're familiar with, meet the criteria that we've put together over here on the left-hand side, thus making it a little bit easier to determine what it is that we want to add to our portfolio in order to get that information technology exposure. So I'm going to go ahead and clear this out. And I'm actually going to go back to our ETF research page. And I'm going to show you one more way to do this. I'm going to go to the sectors tab here. And remember, I told you there's a variety of different ways we can do this, but if I'm on the sectors tab, and maybe I'm doing some research here, I've started to look at a couple of different ways that I can add to different sectors, but I decided that based on what we have here, the information technology, I'm going to stick with that. So I'm going to open this up and expand the information technology. And so here we're going to learn more about the sector, including some information about the performance of the industries that make up the sector. So up on top, we can see find investments. And again, this is going to be based on Morningstar with ETFs, the Morningstar sector theme. We already know about that. But right here, I can click ETFs, and it should bring us to a familiar spot. And here we are again on the ETF screener. And as we started before with the sectors and technology, once again, we're back at the same place, starting at that same 120 ETFs to choose from. So this time, let's go ahead and let's repeat kind of the process, but I'm going to go and actually look at the exposure to the sector one more time. And I'll stick to the theme of information technology, but I also want to drill down a little bit deeper. I already know that information technology is something that I'm interested in. I actually want to get into not just the sector, but the industry. And so at this point, I'm thinking to myself, I'd like to add some diversification to my portfolio in the form of adding semiconductors. So I can scroll down to the industry for semiconductor and semiconductor equipment. And now I've added that to my list as well. And again, from here, we can go through the process of drilling down even further. For this section, I'm going to say I want at least, I'm willing to take a little bit less than 75. I'll go 25% this time. And right away, you can see we're down to 50 out of the 120 immediately for semiconductors. Now, just like last time, I might want to take a look and make sure that I'm only dealing with some of the larger funds. So I can go get, again, right back to net assets. This time I'll say very high. And so now we're down to 13. And again, I'm going to also go back and just stick with what we were looking at before and say trading characteristics. I'm going to go back to that volume, that 90-day average. And this time I'll go, very high as well. And so now we can see we're down to 9 total that actually have the ability to meet those criteria. Now, what if I said, I actually want to change this? I'm going to change this to 500,000 or more. Well, now we've moved down to 5. So the list is quite a bit smaller, and now we can start to take a look at some of the opportunities that we have here. Let's say, for example, I actually am a pretty active trader, and I'm more actually interested in trading options on it. I can hit optionable, and I'll hit yes for trading options. Now here we are again, 4 choices that meet that criteria and trade options. So again, from 120 down to 4. And as with anything, the goal here again is to get these into more digestible bites. And we've done that by looking at only 4 different ETFs that cover technology, specifically information technology, and even more specifically semiconductors. They have large assets, and they have good volume, and they have options. And now I've got 4 choices to continue to expand. These 4 funds, and probably some names that you're familiar with, meet the criteria that we've put together over here on the left-hand side, thus making it a little bit easier to determine what it is that we want to add to our portfolio in order to get that information technology exposure. So I'm going to go ahead and clear this out. And I'm actually going to go back to our ETF research page, and I'm going to show you one more way to do this. I'm going to go to the sectors tab here. And remember, I told you there's a variety of different ways we can do this, but if I'm on the sectors tab, and maybe I'm doing some research here, I've started to look at a couple of different ways that I can add to different sectors, but I decided that based on what we have here, the information technology, I'm going to stick with that. So I'm going to open this up and expand the information technology. And so here we're going to learn more about the sector, including some information about the performance of the industries that make up the sector. So up on top, we can see find investments. And again, this is going to be based on Morningstar with ETFs, the Morningstar sector theme. We already know about that. But right here, I can click ETFs, and it should bring us to a familiar spot. And here we are again on the ETF screener. And as we started before with the sectors and technology, once again, we're back at the same place, starting at that same 120 ETFs to choose from. So this time, let's go ahead and let's repeat kind of the process, but I'm going to go and actually look at the exposure to the sector one more time. And I'll stick to the theme of information technology, but I also want to drill down a little bit deeper. I already know that information technology is something that I'm interested in. I actually want to get into not just the sector, but the industry. And so at this point, I'm thinking to myself, I'd like to add some diversification in my portfolio in the form of adding semiconductors. So I can scroll down to the industry for semiconductor and semiconductor equipment, and now I've added that to my list as well. And again, from here, we can go through the process of drilling down even further. For this section, I'm going to say I want at least, I'm willing to take a little bit less than 75. I'll go 25% this time. And right away, you can see we're down to 50 out of the 120 immediately for semiconductors. Now, just like last time, I might want to take a look and make sure that I'm only dealing with some of the larger funds. So I can go get, again, right back to net assets. This time I'll say very high. And so now we're down to 13. And again, I'm going to also go back and just stick with what we were looking at before and say trading characteristics. I'm going to go back to that volume, that 90-day average. And this time I'll go, very high as well. And so now we can see we're down to 9 total that actually have the ability to meet those criteria. Now, what if I said, I actually want to change this? I'm going to change this to 500,000 or more. Well, now we move down to 5. So the list is quite a bit smaller, and now we can start to take a look at some of the opportunities that we have here. I actually am a pretty active trader, and I'm more actually interested in trading options on it. I can hit optionable, and I'll hit yes for trading options. Now here we are again, 4 choices that meet that criteria and trade options. So again, from 120 down to 4. And as with anything, the goal here again is to get these into more digestible bites. And we've done that by looking at only 4 different ETFs that cover technology, specifically information technology, and even more specifically semiconductors. They have large assets, and they have good volume, and they have options. And now I've got 4 choices to continue to expand my research on as well. So that would be a great use of the screener. Let me show you one more quick one that I think is worthwhile, and then I'll pass it back to you, Peter. But let's just say instead of looking at the industry exposure and saying, I want semiconductors, let's say, actually, you know what? I don't really want to include any semiconductors in this one. So I'm going to hit this button right here that says exclude ETFs with any exposure. And now I've got 20 that are information technology, but exclude semiconductors. So now I can go about the whole process again and start filtering out the ones that I think are important, or at least fit the criteria that I'm looking for as far as diversification in my portfolio goes. So this is the screener, and this is the way we can use it. Obviously, there are a tremendous amount of options to choose from. I'm just showing you some of the more popular ones that I know a lot of traders take a look at, but you can start to get into a lot more detail with regards to your screener. And I encourage you to